You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is crowdfunding and fintech expert, Mark Roderick. Mark is one of the leading crowdfunding and fintech lawyers in the United States. Expanding on his in-depth knowledge of capital raising and securities law, Mark represents many portals and other players in the crowdfunding field. He writes a widely read blog, crowdfundingattorney.com, which provides readers with a wealth of legal and practical information for portals, issuers, and investors. He also speaks at crowdfunding events across the country and represents industry participants across the country and around the world. Now, based on the ever-changing world of real estate investing as we know it today, more specifically, how crowdfunding is changing the landscape as we know real estate investing today, I thought it'd be great to bring Mark onto the show in order to have a deeper discussion around this, what I feel is a very important topic. And so I'm very excited to get onto the show with Mark. But before we do, here's a quick word from our show sponsor, Sunrise Capital Investors. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Now, without further ado, I'd like to welcome our guest for today's show, Mark Roderick. Mark, how you doing today, my friend?
Very well. Thank you very much for having me.
Yeah, thanks for joining us. I know you're a very busy individual, traveling the country, traveling the world, speaking to the world about crowdfunding. And so we're very grateful to have you here today. And if you would, Mark, give us, our listeners, a little sense of geography of where we're calling you at today.
I am at this very moment in a town called Cherry Hill, New Jersey, which is just outside Philadelphia. Philadelphia is a city on the eastern seaboard of the United States.
I hope everybody knows that. If not, they need to go probably listen to a few other podcasts before this one, right? Some basic elementary ones. But in any event, well, Mark, really excited to have you here on the show. And, you know, crowdfunding is one of those topics that has become mainstream headlines, at least in the real estate investing world and multiple other industries as well over the past, 5 to 10 years. Ultimately, it's been a discussion of bigger and bigger quantities very recently. And so I really want to cover, you know, we probably won't be able to dive too deep, but ultimately from a 10,000 foot view, hit on some relevant topics regarding crowdfunding and the relevance it has in the real estate investing space. Our listeners of this show are investors that are out there investing in commercial real estate type of assets, apartment complexes, mobile home parks, office buildings, self-storage facilities, assisted living, and the list goes on and on. Crowdfunding it's a big component of our business today, of our investment firm, and I know a lot of the listeners as well. And so with that being said, maybe for those that, I don't know how they wouldn't be familiar with it, just in case there's some listeners that aren't familiar with what crowdfunding is, maybe take a brief moment and just give us the general definition of what that means.
Okay, I will do that. I'll try to do it succinctly. So for purposes of cocktail party conversation, if anyone says you're at a cocktail party and anyone says, well, what is crowdfunding? Is this crowdfunding? This isn't, and there's an argument. You will seem like the smartest person in the room if you say crowdfunding is any time you are using the internet to raise money. And that's pretty accurate. It's a pretty good working definition and makes you sound super, super sophisticated, which is, you know, the point when you're at a cocktail party. So within that universe, which is a pretty large universe, we can say that crowdfunding started with Kickstarter, right? Mm-hmm. That's what Kickstarter does. You use the internet to raise money. And all of us very sophisticated securities lawyers, when Kickstarter began, thought this is going to fail because we know how hard it is. You know how hard it is to raise money, even when you're giving people something in return. And in Kickstarter, of course, you don't get anything in return. You get a baseball cap or something. Needless to say, you know, a few $1 billion later, Kickstarter did not fail. But in any case, Kickstarter was the first kind of crowdfunding where people just give money to other people basically for free. Mm-hmm. So then we get this law, the Jobs Act of 2012. That allows you to use the internet and any other form of advertising to raise money for investments. And we call that crowdfunding too. We distinguish it by saying, well, now this is, we call equity-based crowdfunding or equity crowdfunding, whereas the Kickstarter was donation-based crowdfunding. And the very important thing to understand conceptually is how new and earth-shattering this new law was from the perspective of our securities laws. Our securities laws, which were all written in the 1930s in response to the Great Depression of the 1920s, have a few fundamental features. And one of those fundamental features is that there are two different kinds of securities offerings. There are public offerings, like Facebook and General Motors and those kind of companies. And there are private offerings like you. You're raising money for a private real estate fund. And this fundamental concept was that there are two kinds, and ne'er the twain shall meet. So if you're in a public offering, you can advertise. And if you're doing a private offering like yours, you absolutely 100% cannot advertise that offering because it's private. That's what private means. So this was just a fundamental core concept. If you asked any securities lawyer, what is the most important rule about private offerings, that person would say you cannot advertise. So that's what the Jobs Act changed. For the first time in history, it allows you to advertise small private offerings. And that is just a gigantic change. And that's what really all crowdfunding is. I always say that, fortunately, there's lots of complicated legal rules, because otherwise you wouldn't have to hire me. But that's missing the forest for the trees, because at its base, crowdfunding is just using the internet to raise money.
What was the ultimate catalyst for the Jobs Act?
Well, that's a great question. I'm not sure anyone has ever asked me that question. The catalyst, I'll take a step back and be a little bit philosophical. But if you look at the history of business laws, like the development, all these different kinds of entities we have, we didn't even used to have corporations way back hundreds and hundreds of years ago. But then business people needed a vehicle to conduct business without putting their entire personal net worth on the line. So we got corporations, and then fast forward, we got S corporations and limited partnerships, and now LLCs. These are all responses to the needs of business people. The law always lags behind, but eventually it catches up. So look what we had in 2012. We had a world where the internet is sort of taking over more and more of our lives. We're making travel plans on the internet, calling taxis, we're making hotel reservations, we're finding significant others on the internet. It was only a matter of time that the internet would be allowed to raise money. It's really a marriage made in heaven. So when you say, what's the impetus? It was such an obvious fit. If you raised money before the Jobs Act, you know how hard it was. The capital formation industry in this country was horribly inefficient, opaque, meaning the opposite of transparent. To raise money, you had to know someone, right? You had to have friends with money. It mattered where your parents went to college, or whether your parents were members of the local country club, or where you lived. An industry in dire need of disruption. Now we have the internet, where you, as a real estate syndicator, can reach literally every investor in the world, and where your listeners, who are investors, can literally see deals from all over the world and choose the best one. I mean, that was the impetus, because the business case is just so compelling.
Yeah. So I could sit here and make a list of all the benefits that come along with the Jobs Act and the ability to advertise these public offerings. But just being in the space and being very privy to the catalyst behind this, and how things were prior to and how they are today, what are some of the downsides that you've seen kind of play out? Are there any?
There are really no downsides specific to crowdfunding. From an issuer's perspective, from your perspective, looking for investor money. Of course, anytime you use money from investors, you are taking on risk, right? Because if you lose the investor's money and you did something wrong, then you can get in trouble. You can be sued. That's always been true. Before crowdfunding is true. After crowdfunding, it's true. In crowdfunding, you're dealing with strangers, right? You're advertising through this show. You have a website. You're dealing with strangers, and maybe it's more likely that a stranger who loses money will be upset and will sue you personally. From a lawyer's perspective, that's not much of a risk. There is a risk in any kind of dealings on the internet, even in the Kickstarter space, for example, that the space will attract dishonest people So in some ways, when you allow crowdfunding, you allow the sort of depersonalization of the business relationship. There is more of a risk that people are going to get scammed. So far, knock on wood, there has been basically zero fraud in the real estate crowdfunding space, much less fraud than most people anticipated. So the answer is not really. There's no additional risk. Just as if you're making travel plans, are there additional risks because you're using Expedia rather than your local travel agent?
Right.
Not really.
Yeah, only big benefits I can think of from the analogy you just provided there.
Yeah. Well, and that is, look in every industry, hotels.com, match.com. What the internet does when it comes to any industry is it bypasses middlemen and it connects directly buyers and sellers, right? And it just goes over the head. It builds a bridge over the head of all those middlemen. In the real estate world, the sellers are folks like you selling real estate investments. The buyers are investors. And crowdfunding allows those two groups of people to touch each other directly without needing, finders and brokers and investment bankers. And of course, that creates incredible choice for investors because they can see all these deals out there all over the world, and it reduces cost and increases transparency and all those good things.
Yeah. You speak to the three flavors of crowdfunding. What exactly do you mean by that?
When I use that phrase, this is what I mean. The Jobs Act, which was signed into law by President Obama in 2012, created three kinds of crowdfunding. So I refer to them as flavors. And the three flavors are referred to by the title of the Jobs Act in which they appeared. When laws are passed by Congress, the different sections of the law are referred to as titles. So we have Title II crowdfunding, which is what you do, Rule 506C. That's the most common, accredited investors only. We have Title III crowdfunding, which we don't see a lot in real estate, but we do see some. That's the very heavily regulated kind that is done only online, only through licensed funding portals, and where you can only raise about $1 million a year. That's Title III. And then there's Title IV, also known as Regulation A or Regulation A+, which is a sort of mini public offering where you can raise money from both accredited and non-accredited investors limited to $50 million a year. So those are the three flavors.
Okay. Well, why would one choose an A+ offering over a 506C? One of the immediate reasons that obviously stand out are the ability to take non-accredited investors. But what are some of the other big differences between a 506C and an A+ offering?
It's funny you should ask me that question because
you probably get asked all the time, I'm guessing.
Well, I was asked 10 minutes ago.
There we go.
I was on the phone. A guy found me and called from Chicago and was asking me that very question. This is the answer. The answer is you use Regulation A only if you really want or need to raise money from non-accredited investors. And let's think of the situations where that might be true. So outside the real estate industry, for example, the first big success story of a company raising money using Regulation A was this company called Elio Motors that promises to produce, it might or might not ever produce, but it promises to produce this super sophisticated, environmentally friendly vehicle. It doesn't even look like a car, but it looks like a kind of space vehicle. And they came to the table with an enormous social media following because it's a sexy thing. It's cool. It's environmentally friendly, very attractive to millennials. So it was sexy. And they had a large social media following. They used Regulation A, and they basically turned their Facebook followers into investors. That was a tremendous example of a company that really fit well with Regulation A. Their consumers were going to be non-accredited investors.
Yeah.
So it made total sense for them to raise money from non-accredited investors. In the real estate space, if you had a super sexy, well-known project, for example, I was involved with one in Napa, California, very well-known piece of real estate. Thousands of people walk in and out every day. And the idea was all those people want to be associated. It's almost like buying a T-shirt, from a historic spot. You could buy a share of stock and get ownership in that building. And so again, there was a sexiness to it, an existing interest by non-accredited investors that you could take advantage of, not take advantage of in a negative way, but build on, let's say. So those are a couple examples of why someone would use Regulation A, because it has an appeal to non-accredited investors. I guess a third reason, and really there's a backstory behind this that I won't go into, but almost the reason crowdfunding came into being initially was that real estate folks like yourself got tired of dealing with the private equity guys from Manhattan, right? Because you'd have a big project, and you go to the private equity guys, they would take a huge piece of it. They'd,
bully
around. And finally people said, the hell with this. There's got to be a better way. And so without going into detail, as a general matter, the sponsor gets a much better deal dealing with the crowd than dealing with private equity guys. With all that said, there has to be a positive reason to use Regulation A rather than Rule 506C. Rule 506C is faster, cheaper, much less regulated. So if you think you can get your deal funded using Rule 506C from accredited investors only, that's what you do. You use Regulation A only if you have some special reason that you want or need to raise money from non-accredited investors. Now, I have clients who have done it very successfully for business reasons, and from an ideological perspective, I have clients who feel very, very strongly that, the history of capitalism in our country, and specifically real estate investing, is that the best deals are always reserved for the super wealthy. So the wealthy get wealthier and the middle class doesn't get wealthier. And these clients have had very successful Regulation A offerings, giving tremendous deals to non-accredited investors just because my client thought that was the right thing to do. And it's worked very successfully.
You made a mention that the Reg D 506C offering is much less expensive and quicker than the A+ offering. Can you elaborate on that a little bit?
I sure will. And again, I'll go back to the history of the U.S. securities laws. Along with the public offering, private offering dichotomy, maybe the other fundamental tenet of our securities laws has been this distinction between accredited investors and non-accredited investors. The assumption has been that accredited investors, who used to be wealthy people, the definitions have sort of eroded, but that wealthy people could take care of themselves because they can hire expensive lawyers and accountants and advisors. And non-accredited investors, ordinary Americans, could not and needed the paternalistic arm of the government around their shoulder. And every time I say that, it sounds sarcastic, but in fact, that has worked pretty well. So this was a fundamental tenet and continues to be a fundamental tenet to this day. So in 506C, it's accredited investors only. And when they're only dealing with accredited investors, the government basically says, do what you want, caveat emptor, let the buyer beware. We're not going to regulate you at all. Whereas in Regulation A, which allows non-accredited investors, now we need this paternalistic arm of the government. So it's very, very highly regulated. In Rule 506C, the law doesn't require you to give any disclosure to investors, for example. None. You can do a Rule 506C offering. You could start now and have your offering online in 15 minutes from now with no disclosure. It would be perfectly legal. Whether it would be smart is another story, but perfectly legal. A Regulation A offering, if you start right now, you will be selling securities in about 4 or 5 months, not 15 minutes. And you'll have to get approval from the SEC and put together this thick book. And so that's why it's so much more time consuming and expensive. It all comes back to this tenet that the government protects non-accredited investors and doesn't protect accredited investors.
What is the general cost one would associate with setting this up? And I know there's probably variables involved there and there's ranges, but just generally speaking, can you give a ballpark of what an A+ might cost to get set up?
Yeah. A typical real estate Regulation A offering is going to cost in legal and accounting fees between $50,000 and $75,000, depending on a bunch of stuff, but how complicated it is. But that's a very safe range. And I should also say, at my blog, I have a whole section on Regulation A, which has a whole timeline, this beautiful visual thing. I didn't put it together, but someone in my office put it together, and cost estimates and all the different people that have to be involved, the team, and lots of stuff. So I hope your listeners aren't writing stuff down right now. There's a lot more detail there.
Okay. One thing we haven't talked about, Mark, is Reg D 506B. Now, B is a private offering as well, correct? That ultimately you can take a number of non-accredited investors. It's 25 or 35? I've never done one, but
35.
35, okay. And so in the scenario of someone making a decision that they'd like to make their offering available to non-accredited investors, why would one not go the route of a 506B versus an A+?
Well, for the reason that you just said. So in a 506B offering, you can have up to 35 non-accredited investors. In a Regulation A offering, you can have 10,000.
Unlimited, yeah.
So it just depends how many people you're talking about. Rule 506B offerings, yeah, they're pretty rare, actually. I guess I would say. So as you know, but I will just point out for your listeners, the thing a listener might be saying, oh, great, I'll do 506B rather than 506C, and then I can have some non-accredited investors. But there are two things about that. One, if you do a Rule 506B offering, you cannot advertise. Now we're back to the 85-year-old rule, no advertising. So it's only going to be people you know and people who know people you know, basically. Your sort of circle of people, no advertising. So that's bad. And the second thing, going back to that second fundamental tenet of our securities laws, the moment you admit one non-accredited investor, just one, so you say, I'm going to raise $1.5 million. I got a guy over here, my father-in-law or some acquaintance. He's not accredited. I told him he could participate in my next deal. He's going to invest $20,000. Just one non-accredited. Now you have to provide a whole bunch of information because, again, here comes the paternalistic arm of the government protecting that one guy. So you're going to substantially increase the price of the offering and, in some ways, the time it takes to complete as soon as you admit a non-accredited investor under Rule 506B. So paradoxically, most Rule 506B offerings only include accredited investors, even though they could include 35 non-accredited investors.
Yeah, no, that makes sense. I had this discussion a couple of weeks ago at a conference with somebody that they've done a few 506Bs, and they actually had no non-accredited investors in their offering. And I was so confused as to why they just didn't do a 506c and actually at least give themselves the opportunity to generally solicit it and increase the size of their investor database from just the immediate folks that they already had a relationship with. And they didn't really have a good answer. And so I was confused as to why they continued to go that route. It's probably at the direction of their securities attorney, but I thought maybe there was something I didn't know that I wasn't aware of why they might have made that decision.
Here's the missing piece, that the reason to go 506B rather than 506C is that, as you know, because you're doing a 506C offering, when you do 506C, you have to verify that all of your investors are accredited, which usually means hiring a third-party company. There's a company called Verify Investor that does it for you. Mm-hmm. In a Rule 506B offering, you do not. You can just rely on the investors putting his hand on his heart and telling you, I'm accredited. And some people don't want to verify. Now, why? Well, some accredited investors don't like the verification process and drop out. But I think that's actually a very tiny percentage. The main reason to use 506B is so people can lie. I probably shouldn't say that, but that's the truth. So that you can let non-accredited investors into your deal because they're willing to lie to you.
And where's the liability fall in that scenario? Does it fall on the actual sponsor or the investor themselves if someone actually lied to get into an offering?
Yeah, the answer is there's no liability unless the sponsor should have known. So, like if your 14-year-old nephew signs up and says he's accredited, then you have liability. Or if it is that childhood friend and you know darn well that he's not accredited and you let him in the deal, then you have liability. But there are a lot of close cases. And I have had a lot of clients have situations where someone wanted to get into a deal. They were willing to lie, perfectly willing to. They did lie on their subscription documents, but they just weren't accredited. So in a 506C offering, we couldn't let them in.
Mm-hmm. Very interesting. We've never received any pushback whatsoever from
there you go.
And we use Verify Investor. And I mean, I guess there could be. And if we have, maybe it's been one out of, hundreds. It definitely is a inconsequential number. And it's a fairly streamlined process.
Very streamlined process. I actually had a situation recently where I, as the securities lawyer, advised the client that they did not need to verify. And the reason was they said, we got this guy, he wants to invest. And they sent me his resume along with a number of articles, like from Forbes, about this guy. I mean, he's just like one of the leaders in his field and has sold companies for $1 billion. So when I say I told them we didn't need to verify, that actually, I shouldn't say that because that is inaccurate. We did verify. The process of looking at those Forbes articles was verification. So that's unusual, and I don't want to leave people with the impression that that's how you should do it normally. But this guy said, I've never been asked to verify. And in that case, he was telling the truth because no one would ask him to verify.
Right. Yeah. Okay. Fair enough. I'd like to change the topic a little bit and talk about the different portals that exist out there, and there's more and more coming online every day. And I'd love to hear from you the role that these different portals play. You got Realty Mogul, you got Realty Shares. There's probably hundreds of them now. There's some of the big guys, and in addition to that conversation, and just kind of getting some feedback from you as to the role they play, there's one big one that recently folded. And so I'd love to get your perspective on that as well, if you wouldn't mind.
Sure. And the one that folded was one you actually mentioned, Realty Shares.
Realty Shares, right.
Yeah. Mm-hmm. So I think personally, portals are super important because the portals are sort of the gatekeepers. Mm-hmm. And the portals, as you know, the portals do due diligence on deals and on sponsors. And in my opinion, for the market to develop the way I think it's going to develop, your average retail investor out there is really not in a position to assess deals and sponsor credibility himself or herself, and needs some kind of third party. Just as the retail investor in the stock market today prefers mutual funds with a professional choosing the stocks, I think that the future of real estate crowdfunding is in funds that are, managed by experts. And today, I'm not sure how the market will look in 5 years, but today that role is being played by these larger, reputable real estate crowdfunding websites. So I personally believe they play a critical function. They lend credibility to the market. I said earlier, there hasn't been any fraud in the real estate crowdfunding world. I think that's at least partly because of the role that the crowdfunding real estate portals have been playing. Realty shares, boy, now that is at a certain kind of cocktail party. That would be the subject of maybe not a very interesting cocktail party, but a cocktail party of real estate folks and crowdfunding folks. That would be topic number one. What happened? And not that I have any super inside knowledge, but the information from what I know from the industry, this was a perfect example of why not to finance your business with venture capital. Realty Shares was financed with a lot of venture capital. And as we know, venture capital is not very patient. And venture capital is always about growth, market share, spend money. And as I understand it, again, just my imperfect knowledge, they spent a lot of money and hired a lot of folks, and they just couldn't grow. The industry wasn't growing quickly enough, or they weren't growing quickly enough to justify burning all that cash. So, that business model of spend a lot of money to buy market share and to buy earnings just didn't work for them. In contrast, other successful real estate crowdfunding portals have a lot fewer people. They're doing more volume with a lot less people. So it's just it was a business model as far as I know. I mean, I have to say, I was surprised. I think maybe people in the industry, not everyone was completely surprised, but it was a disappointment for the industry for sure.
Well, they were one of the first. I mean, they were one of the first big ones in the space. I don't know if they were the first. I think Realty Mogul maybe was. I can't recall.
It was.
But it took me by surprise. So I appreciate your perspective and your feedback on that. And I'm wondering if there are any other of the larger players out there that are fueled by venture capital that ultimately might run into the same situation. And in addition to that, obviously we're in an up market right now, so it's quite easy to make money in real estate when everything continues to go up. You can be a lot more aggressive with on the buying side with much thinner margins, ultimately, because again, rents are going up, values are going up, cap rates are being compressed. I guess the coming years will tell, right? Time will
I mean, the question for the industry is, what happens to real estate crowdfunding and to the portals specifically when the real estate market turns down, which you and I both know that it's going to, and I don't know the answer to that. Because crowdfunding is just the internet, and we use the internet for everything, I have no doubt that real estate crowdfunding is going to survive and prosper. And I think that the most successful real estate crowdfunding sites will survive and prosper because they're run by great business managers as well as great real estate folks. But it's certainly going to be interesting. I mean, what we're already seeing, I hear from a lot of my clients that the market is, already, it's getting harder and harder to make money.
Sure.
And so projections, people used to want to project a 21% IRR. And now, you're not projecting 21% IRRs. And there's a little nervousness whether the investing public is going to say, 14 IRR, that's nothing. Why should I invest? So we're starting to see the market change now. And who knows how that's going to play out.
Yeah. Any other information? We're running out of time here, so I'm going to be respectful of your time, Mark. But any other information that you feel is necessary for us to cover, generally speaking, as it pertains to crowdfunding for real estate?
I think the market it's just the internet. And we're maybe with real estate crowdfunding finance, maybe we're where we were with the travel industry in about 1996, where some people had dipped their toes in, but it was unusual. So you would tell someone at a cocktail party, guess what I did? I made my reservations on the internet. That's pretty cool, right? Well, of course, now you don't, right? Because that's just, how it's done. We're probably at about that stage. I don't think it's going to be very many years before anyone, any real estate developer, sponsor, the first step in looking for capital will be crowdfunding. It just makes such perfect sense.
Yeah, I agree. And that's a great comparison about where we were, I think you said 1996 with the travel industry being web-based or on the internet. So that's I've never thought of it that way, but I think you're right. So very interesting. Well, Mark, this has been a lot of fun. I really appreciate you coming on the show. You've shared a lot of great information, lots of golden nuggets. And ultimately, I'd like to enter what we call the golden nugget segment. So I hope you saved one. I hope you saved one last golden nugget for this part of the show. And this is where I'd like, if you could, if you had one last golden nugget of advice or wisdom that you could leave with our listeners today that may motivate and inspire them as they progress in their real estate investing career, what would that one last golden nugget be?
Well, obviously, listening to your podcast.
That's a given, right?
Yeah, I think that it's a little bit tedious, but if there are any of your listeners for whom this is all new, what is this crowdfunding about? So I speak about crowdfunding a lot, and I always give this advice. One, definitely visit my blog. There's a gigantic amount of information there. But more important, and this is what I tell all my audiences, sign up at some crowdfunding sites.
I love it.
That is the best way. It's easy. It's on your internet. It's on your phone. Sign up and just look through, leaf through, click through, and you will get a different, I don't want to say better, but different and possibly better perspective than you will from listening to me talk, even as unimaginable as that might be. But you really see what's going on out there. You see what the deals are, you see the mechanics, and you immediately start to feel comfortable with it. So I guess that's my golden nugget. Sign up, walk through it, see what it's like.
No, that's great information. In fact, I did an entire show on that, Mark, probably about a year ago, on that very specific topic of, if you're looking to raise capital, if you want to see what other folks are doing, if you want to, leaf through multiple offering docs, PPMs, OMs, go sign up for 5 different crowdfunding sites and start looking at deals, underwrite deals, and see how each one does it differently. Take that 250-page PPM, read through it in your spare time, read through 10 of them if you have time for it, and ultimately get a feel for what's happening out there in the real world. So no, I think that's fantastic advice. And Mark, your website, your blog, it's crowdfundatty.com. So crowdfund attorney, but it's ATTY, crowdfundatty.com. And guys, I'll put that in the show notes as well so that you can click through and get on his website. And Mark, this is all we have. So I really appreciate you coming on the show. It's been great having you here. And I'll look forward to staying in touch with you and hopefully have you on the show at a future date again.
That would be terrific. I really enjoyed talking with you and hope to do it again sometime.
Take care.
Take care. Bye-bye.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.